Legendary investors Jim Sinclair and Egon von Greyerz tell us that there's no good reason to actually worry about gold confiscation. Today we explore 4 key reasons why we shouldn't worry about gold confiscation, at least not yet. So let's dive on in. Now, this channel provides global macro insights for informed investing, so do consider subscribing. Now, Ralph Waldo Emerson's famous words on gold highlight our feelings towards the yellow metal perfectly, I believe. That the desire of gold is not for gold, it is for the means of freedom and benefit. And so when we start talking about gold confiscation, we are talking about restrictions on freedom, something none of us like at all. The first reason that we shouldn't worry about gold confiscation is that we no longer live in a world of rigorously fixed exchange rates under a gold standard regime. Under this system, countries had to forego sovereign monetary policy. That is, the control over the money supply. This limited the amount of currency that a country could actually issue, as this would lead to subsequent devaluation of the currency reflected by an outflow of gold. Yet the Federal Reserve allowed enormous credit expansion to take place prior to the Wall Street crash, and that helped to facilitate that very crisis. The subsequent bank run that took place on the Fed, as we considered in this video, threatened to highlight the complete failure of the Federal Reserve to the point that the institution could have been abolished. In the midst of the economic panic, Americans were effectively encouraged to hoard gold, which had the consequent impact of reducing the money supply and prolonging the debt deflation. Under the post-World War II Bretton Woods standard, the US had far greater control over their monetary policy, but this was not the case for other countries who had to maintain their exchange rate fixed to the US dollar. Issuing more currency for those countries would have led to devaluation unless they had sufficient gold backing. Thus, Australia and the UK later introduced gold confiscations to stop their citizens from abandoning their domestic currencies. Devaluations under the gold standard regime could not be concealed easily as they can today with our floating exchange rates. Instead, governments would have to publicly announce these devaluations to take place, one of which was seen in the Netflix series The Crown. Here's Harold Wilson lying to the British public in 1967 about the pound's devaluation.
From now on, the pound abroad is worth 14% or so less in terms of other currencies. That doesn't mean, of course, that the pound here in Britain, in your pocket or purse or in your bank, has been devalued.
But since the introduction of floating exchange rates, governments have had enormous success in being able to steal through inflation and devaluation, which is far easier and politically more acceptable to actually achieve. In fact, we know that central banks will take a very relaxed view towards inflation overshooting in coming years. If we consider John Williams' shadow stats figures for real CPI inflation for the US, not the largely meaningless CPI measurement that is quoted to us in our newspapers, an inflation rate of around 6% is quite common, and many will think this is generously low given the amount of quantitative easing that has actually taken place to date. This allows for a real reduction of national debt of $26.5 trillion currently by over $1.5 trillion per year. Let inflation run higher at 8% or so, and that takes it over to $2 trillion reduction in the real size of the debt each year. This is a sizable amount. Such an inflation level could easily be achieved by using the current CPI level of inflation and letting that run at 4%. The annual compounding impact of such an approach is absolutely huge, and this approach stands up so incredibly well against the forced nationalisation of private gold. And while it is almost impossible to calculate how much gold is held by US citizens, in 1932 it was estimated to be around $1.4 billion. If you divide this number by the then gold price of $20.67, it gives us a figure just shy of 68 million ounces. Yet this article suggests that almost a fifth of this gold was never realised by the Fed, and such leakage amounted to almost 13.9 million ounces. Thus the total gold nationalisation amounted to 53.85 million ounces. Now, making a very crude assumption that these figures are roughly comparable to today, almost 100 years later, a very big assumption I know, gives us the total confiscation at today's prices of less than $100 billion. Of course, if the gold price goes to $20,000 or $50,000, such an argument becomes far more plausible. It was for this reason, among others, why I asked just how high we want to see gold prices to go. Nevertheless, the impact of the inflation tax is far more effective than gold nationalisation. Combine this with other wealth taxes on, for instance, second homeowners, and this seems far more plausible. As does the potential for tax changes on bullion, which again are far more easily administered than nationalisation, particularly as much gold is held overseas within a global gold market. Second, with the ability to freely inflate and devalue currencies, we live in a very different era from when Roosevelt bailed out the Fed. Then the key issue was a shortage of gold. The Fed had overseen the issuance of too much credit, and as Roosevelt put it,
behind government currency, we have, in addition to the promise to pay, a reserve of gold and a small reserve of silver. Neither of them anything like the total amount of the currency.
Roosevelt faced a restraint in not being able to actually create too much money in the repurchase of gold and its subsequent revaluation. The corrupt Roosevelt then chose to side with the bankers rather than the people. Thus, citizens were only offered the standard gold rate of just over $20. When the nationalisation was complete and the Fed's gold balance was dramatically improved, gold was revalued at $35. And here's Jim Sinclair's take on the differences between the monetary system we now have. In the 1930s, gold was to the monetary system what quantitative easing is today, a means of increasing the supply of money. President Roosevelt set the gold price higher because to create money then, the system required a higher value of gold to have more money outstanding. This is why Roosevelt ordered the confiscation of gold to unfold his type of monetary stimulation, his QE. And so Sinclair argues that this is lost on many, that really suggest that there is a high probability of gold confiscation. Third, the war on cash and electronic money means that it is easier than ever to conduct bank bail-ins, prevent asset sales, and promote exchange controls to limit downward momentum on a currency. After all, gold is only around 0.5% of global assets. Consider Cyprus's debt crisis in 2013 as an example here, where the immediate policy response was to impose a bank deposit levy of 47.5% on bank deposits over 100,000 euros. This was seen as a one-off tax on private wealth to help raise the 5.8 billion euros to avoid being kicked out of the single currency. It was so much easier to administer versus gold confiscation. Roosevelt did not have such options available to him. Nevertheless, Germany's desire to actually hold information on those buying more than 2,000 euros worth of gold is a concern. Fourth, and this is a biggie, The economic consequences would be severe. It would fully expose developed nations as paper tigers whose economies and currencies have failed. Meanwhile, Asian economies have proud traditions of holding and trading gold, and as Egon von Greyerz has said, with the epicenter of the gold market moving to China and the East, it is very unlikely for the US and the West to confiscate gold. This would precipitate the fall of the dollar and the euro, and substantially weaken the US and EU positions and their economies. But there are certainly some warnings we can heed regarding any increased likelihood of gold confiscation. First, according to macro trends data in the early 1930s, the market price of gold had actually risen to over $26 an ounce, and thus the dollar had been devalued in the eyes of its citizens. This would have been the time to actually sell. In the midst of such a deflationary backdrop, this was some performance. If the price suppression on COMEX banks breaks down and the gold price truly takes off, this would be an equivalent signal. In addition, in 1932, Herbert Hoover sounded the alarm, stating that the US was close to abandoning the gold standard. And so while jewellery and legal tender coins may be excluded, gold confiscation would be the most desperate of measures, which would usher in a multi-generational loss of trust in fiat currency and the ability of our governments to actually deficit finance and continue the fiat deception. So yes, it's certainly possible, but it's likely to be a last resort in absolute desperation and will face numerous difficulties in its implementation. So there's far easier targets, as I and others such as Egon von Greyerz and Jim Sinclair believe. What do you think? Let me know in the comments down below, and I look forward to seeing you soon. Bye bye.